Thanks for joining us today on Market Call. I'm Morella Fernandez. Cole Kachur on the show with us today, Senior Investment Advisor and Portfolio Manager at Wellington-Altus Private Wealth. He'll take your questions on North American stocks and ETFs. Here's how to reach us. 1-855-326-6266. If you'd like to dial in, you can email your questions in as well. marketcall@bnnbloomberg.ca. Cole, good to see you.
Hey, nice to see you. Thanks for having me on.
Mixed start to the day for the North American markets. What's your outlook for the year?
Yeah, I think it's really the last few months have been mixed with the, confluence of geopolitical issues and, just other kind of headwinds that seem to be prevalent. It seems like the market hasn't really been able to find, a clear direction, which, in the case of a bull market run-up, it's not actually the worst thing. It was a pretty good rebound off the April lows last year, and to have a little bit of a consolidation phase, before hopefully what is the next up, that's kind of a necessary evil. So while it's, not necessarily what we want specifically for the U.S. markets right now, it probably makes the next leg go higher. And our viewpoint is that we should see some market movement. We think as high as 7,400, maybe by the end of April, and as high as 8,000 by the end of the year. But, that's also an optimistic scenario where I think some rate cuts need to happen and some other, geopolitical issues maybe need to get sorted out a little bit. So I think it will be a volatile year, and, volatility leads to opportunity, and it's probably more of a little bit of an active market than maybe last year. Okay.
And you do expect more than one rate cut this year?
Yes. Yeah, I think, depending on how the nomination goes here, I would expect at minimum 2, but probably even 3. I do think economic growth is, slowing down, and certainly some of these tariffs and other things, they do end up hurting the consumer. And so I think later in the year, the economic data will, be a little bit lower than what people might have thought, and that might pave the way to, maybe another rate cut over and above what's currently priced in.
Okay. What is your take on the results from earnings you've seen so far?
I think a mixed bag. Some of the high flyers like AMD, for example, it was a past top pick that we'll go over, and obviously it's trading down today. But certain stocks, they're just priced to perfection, and it wasn't a bad quarter for that stock or really a number of stocks. But sometimes there's just some profit taking or a rotation out of certain investment types into others, and that's just part of the market. And as I said, I think volatility is going to be increased throughout the year, and it probably paves the way to take advantage of some of the high flyers and the winners and repurpose that capital into other places throughout the year, and try to hopefully buy low and sell high.
All right, let's take a quick break. We will line up the phone calls and emails for Cole Kachur of Wellington-Altus Private Wealth. Again, he's taking your questions on North American stocks and ETFs. We're back in a moment. Welcome back to Market Call. We're going to start right now with an email from Charles. He says, can your guest provide some clarity on Bombardier and Airbus's relationship for the C-Series jet program? We'll turn that question over to Cole, who joins us now as our guest today. Cole, this is an area right now under pressure, of course, because of new threats from Washington. But can you explain the relationship here between Bombardier and Airbus?
Yeah, so I think, the caller's question is topical, just based upon, some of the, again, political bargaining where trying to get the Gulfstream jets into Canada, whereas using some leverage over Bombardier. So I think it's a classic example where, you can't necessarily overreact to the news. So if you follow Bombardier stock, when that announcement from the U.S. came out, it saw, a little bit of a dip, and then, shortly thereafter, most of that dip has been recouped. So it's all about political posturing. And as we've seen within the U.S., they're trying to get more of their American-made products accessibility to, other nations, whether it be Canada or otherwise. And Bombardier is a major player specifically in that C-Series and corporate jet market, and the threat of tariffs and basically allowing open competition on the Gulf Stream is kind of what the end result of what they're trying to do. And it seems to be working. As last I checked, I think FTC in Canada here was, reviewing and working with Gulfstream to try to, see what hurdles need to be moved so that they can get into the Canadian market. So again, I think Bombardier is, it's been a really good stock and a good company. And sometimes those types of companies just get caught up in the political posturing.
Okay, I hope that works for Charles. Let's go to our first caller. Peter on the line from Niagara Falls in Ontario. Hi, Peter.
Hi, good afternoon. Thank you for taking my call. Cole, my question is on Brookfield Asset Management. I noticed this morning that they've reported record earnings and record profit. I've noticed some targets of over $100 on this stock. Can I please have your opinion? Thank you. I'll hang up and listen.
Thank you for the question. Brookfield Asset Management. Cole?
Yeah, I think it's, it can be a staple Canadian company inside portfolios, almost one of those months where you just set it and forget it. And it's got a really good management structure. Obviously, they've kind of got their mitts in different pots through their various conglomerates and, subsidiary companies. So, it hasn't done a whole lot actually in the last year. If you look, it's only up about 8 or 9%, I think. And big move, though, from the April lows. And so like a lot of, I guess, the more general market, specifically the S&P, a little bit less the Canadian market, it's just kind of in a sideways trading pattern right now. So, it's just kind of moved sideways for the better part of 6 months. And sometimes these consolidation phases happen, but I don't really see anything, that would scare me about the stock. $100 maybe seems a little bit aggressive to me, but I think there's probably, a 15 or 20% gain in there. I'd be surprised personally if it, moved as high as 100.
Yeah, I was just looking up analyst recommendations. So right now there is a 9 for buys, 9 for holds, and the 12-month target price right now for Peter would be about $61.90 is what I'm seeing. And of course that'd be an American. Let's go back to the lines. Mark is online in Ottawa with a question. Hi, Mark.
Hi there. Your thoughts on Thomson Reuters. Do you own this company? If you didn't, would you initiate a position at this level, and what's your outlook going forward?
Okay, thank you for the question. Thomson Reuters getting hit by concerns about software companies. Cole, what do you think about Thomson Reuters?
Yeah, it was off my radar for a while just because I thought it was overinflated from a valuation perspective. And I was actually just kind of reviewing it the other day. And I think sometimes you see these major sell-offs and maybe some of the concerns are overblown as, I think these companies like Thomson, over the lifespan of a company, they have to reinvent themselves and, continue to adjust and provide value to clients and ultimately shareholders as well. And so I look at, such a significant sell-off and, we're not quite sure how AI and all of these applications are going to play into, a company like Thomson Reuters or other software companies. So, part of me thinks it's a little bit overdone, and that there probably, is a balance to be had here. But you also don't want to catch the falling knife. So, if I was going to look at a position, I'd probably initiate it based on a dollar cost averaging basis where I was kind of looking at over a medium term and, adding capital selectively on maybe periods where it's getting hit a little bit harder.
Okay, that was from Mark. Let's move on to Michael. Michael's in Vancouver with a question. Hi, Michael.
Hello, Marilla. Hello, Cole. Cole, thanks so much for taking my call. My question today is on Microsoft, one of my largest holdings. I was looking pretty good in the summer of last year, but it has gone down about 25%. I just wondered if you had an optimistic outlook on it. Marilla was showing a screenshot, I think on Monday, where there was 67 analysts having a buy on it and only 2 hold, with no analysts having a sell on it. Yet, it's, as I say, it's dropped 25% in 7 months. Could you just give me your outlook on it and maybe give me a little bit more optimistic outlook as well.
Okay.
Thanks, Cole. Have yourself a great day.
Thanks for the question, Michael. Microsoft did report, and stock went down, but we know that investors are being pretty hard on the Mag 7 companies and want very specific things. What do you think of Microsoft moving forward?
Yeah, so just one other comment before we get to Microsoft. I think you have to be careful on analyst ratings. I mean, very rarely is there, sell positions on them. So I think you just have to look at the company and decide, if you like it, and certainly use the analyst rating to maybe help you make that decision. But at the end of the day, I think, there's other vested interests in some of the ratings. So be careful paying too much mind to those. With Microsoft, it's probably similar to Thomson Reuters, maybe to a little bit lesser extent, where there's some concerns about the software sector. And, Microsoft does have, a significant aspect of business there. I think, over time, what I've seen with these like big 6 or big 7 companies is at certain points, some are going to fall behind, and then you look a year later and now they're at the top of the pack, and, something else has fallen behind. So right now, Microsoft is the one that's kind of lagged. And I think personally that, you'd want to go out and, make some purchases sometime around here, because the reality is it's a good company. It's got strong cash flow. It's going to continue to produce significant results. And it's at a similar multiple to what the S&P 500 is, but with significantly higher growth characteristics. So I think, take advantage of the weakness. Good companies don't go on sale that often. And I would probably look at buying here.
Okay, let's take a quick break then. We'll line up some more phone calls for Cole Kachur of Wellington-Altus Private Wealth. Here's how to reach us. Back in a moment. Welcome back. Let's go to Ray on the line in Pickering, Ontario. He has a question today for Cole. Hi, Ray.
Yeah, hello. Cole, I currently hold VDY, the Vanguard High Dividend Monthly Income Paying ETF, and I was looking to diversify. So I was looking for something you might recommend in North American or even a global type of dividend paying fund for me.
Okay, thank you for the question. Do you have something in mind, Cole?
Yeah, so, the Vanguard one is good. Generally with ETFs, I kind of stick to Vanguard or iShares. So a similar kind of one through iShares would be the iShares Global Monthly Dividend Income. Similar type of strategy. So you'd maybe have to look at, the similarities and make sure that you're not getting too much overlap. But, it's had really, strong performance and gets you access to some of the top global markets. So, without having too much risk as a pure equity play, it's probably fits the mold. And, even on the Canadian side or US, there's a lot of, whether it's XDV, I think is the dividend trading ETF in Canada, or there's a number if you look at the iShares site in the US. So I think, generally the global will have some exposure to the US. So you're kind of getting all the diversification that you need there. So I'd probably just stick with the Vanguard or the iShares Global Monthly Dividend.
Okay, that was for Ray. Let's move on to Glenn. He's in Oakville, Ontario. He's got a question today. Hi, Glenn.
Hi, Marilla. Hi, Cole. Thank you for taking my call. My question is on OpenText. I currently have a full position. I understand they report tomorrow. I'm wondering, Cole, is this one you hold? And if you could give me your thoughts on OpenText moving forward. Thank you very much.
Thanks for the question. Some upheaval at this company. Cole, what do you think?
Yeah, so it's not something that I currently own or really have owned, for quite a number of years. And more so just on the basis that, I think there's a lot of other really good technology companies, with the bulk of them not inside Canada. So I think, you could look at a Microsoft or really any of the other major tech companies throughout the US and have a lot better path to, results than you do through open text. So, I can't really comment too much on what the results are going to be like. I would assume, it's kind of in a similar mold to like the software space, and those, unless they report amazing earnings, they've kind of got hit a little bit hard. So, if it was my money, I'd be a little bit careful in open text. I think specifically with the sell-off and, some of these U.S. counterparts, that you can probably get a higher quality name, at a better valuation. So I personally would look to repurpose that capital. But again, I don't know the ins and outs of the position.
Okay. Let's move on to Gordon then. He's in Victoria, BC, with a question about ETFs. Hi, Gordon.
Good morning. Can you recommend one that holds high-quality preferred shares that reset, and also, if you can, one that holds perpetuals?
Okay. Thank you for the question. Cole, go ahead.
I can't. And the sole reason is, I'm just not a big fan of the preferred share market, really, whatsoever. And in my experience with it, I find that you take, all the risk of the equity market, and, these funds often trade at a significant discount to NAV, but then you don't really get any or very much of the upside. So my preference, if I'm looking for income, is, I'd rather just own a pure dividend play, whether it's individual stocks or an ETF. Or if you're looking for enhanced income, I would look at, some of these covered call ETFs that are being offered through banks like BMO or providers like Hamilton. There's nuances to all of them, but in my experience, the preferred share market is just not one that, has traditionally been super kind to investors. And I think there's better places to get income from.
Okay. That was for Gordon in BC. Let's go to Richard in Calgary with a question. Hi, Richard. Richard, are you there? Okay, it looks like we may have lost Richard. Let's go to an email from Polly. Polly says, does the guest have any thoughts on Hudbay? What do you think about Hudbay, Cole?
Yeah, so I think it's been in the right space for, the last 6 or 8 months, with a lot of copper, gold, and silver production. So accordingly, the stocks moved up fairly significantly. So I think it really just depends on your views of, what precious metals and minerals are going to do moving forward. If you think, the price is going to stabilize somewhere where it is, or, even go higher, then Hudbay probably continues to go well. In my experiences, commodities are cyclical in nature. So when the bottom, falls out, the bottom can come pretty hard. And so I think Hudbay is, it's a really good company in the right sector over the last 6 or 8 months. That's going to be, it's yet to be determined if it's the right sector to be over the next 6 to 8 months. So I personally am not, a precious metals guru. I know that on BNN and on the channel here, you guys do have a lot of people who specialize in that sector. So it's probably better suited to them, but I think it's a well-run company. But, I just want to be careful of commodities as we stretch into all-time highs on a lot of them.
Got it. Okay, let's go to an email from George. Can I please have your view on Keyera? Is now a good time to add to my portfolio? Where do you stand on the natural gas play? I remember last year, a lot of people were thinking natural gas was a play for the build out, the energy need for AI. Are you strong on natural gas?
Well, I mean, it seems like for the last, 15 years, everybody has thought that natural gas was going to be the play, and then it's just never really, come to fruition. So I guess I look at a company like Keyera, and I know it's a little bit more specialized to the gas sector, but I would probably look at its peer group, which I would consider to be like Enbridge and Pembina and, TransCanada maybe to some extent. And I think my preference would just probably lie with Enbridge or, one of the other players. I just think a little bit longer track record, a little bit better path to capital if they want to expand and, do these different projects. So nothing against Keyera. It's, if I had to pick, from similar companies, I think I would probably pick Enbridge, but Keyera is fine. It's just not something I own.
Okay. Let's take another quick break. When we come back, we will look at Cole's past picks. That's next. Welcome back. Time to have a look at Cole's past picks. These are from June 10th of last year. At the time, Cole, you chose Estee Lauder, EL, on the New York Stock Exchange. It was 70.46 US at the time. It's up to 117.48, so 68% upside, 68% in total return. Do you remember why you liked this last summer?
Yeah, it was partially just the industry. There was a lot of consolidation going on, a lot of celebrity beauty type product valuation just going through the roof, where Estee Lauder, which is a well-established brand, just kind of got left behind. And so from a technical perspective, it was kind of on the verge of a breakout. And sometimes you just, look at the technical charts and look at the company, and they seem to make sense. And super happy with, the return. And yeah, I would say it's probably reached, the bulk of where I think it can go anyway. So happy to have owned it for, a good portion of the last 6 or 8 months or whatever it's been. But, I think it's probably not the worst place to move on from if you're still holding it.
I was going to ask you, have you held on to it? Have you sort of left it earlier in the year or end of last year?
Yeah. So generally, what I try to do is we'll sell a portion if we think it gets to a specific level, and then kind of leave a runner where if we think there's still upside there that we can, continue to participate in it. So I'd love to say, I bought at the very low and sold at the very top, but, realistically, sometimes you leave a little bit on the table, but super happy, like I said, with what we were able to get out of the stock. Probably achieved a higher return than I would have thought. Okay, let's get to your next past pick, which is CI Tech Giants Covered Call ETF, TXF on the TSX, 2070 at the time you recommended it last June, to 2278, so 10% upside, a 19% total return. Are you still in this one, and why do you like this ETF for tech? Yeah, so I'm still in this. Basically, it's kind of like more of a play on, maximizing income flow with some potential upside from some of the ultra and large cap names, specifically in the US. So it does use a little bit more leverage, so it can be, a little bit volatile, but even now it's still producing around a 10% income yield. So I figure if I can yield out 10%, I'm kind of comfortable, kind of waiting on the markets. And, specifically right now with some of the mega cap names not having performed super well over the last 6 months, I think, it's a good entry point where if those names lead the next leg higher, then not only will you get your cash flow, but hopefully you can see a little bit of, capital gains as well.
Okay. Let's get to your third pick, which did report earnings recently, Advanced Micro Devices, AMD on the NASDAQ. At the time, it was 123.24 last June. It's up to 211.64 today. It's a 72% upside for return and total return. They reported earnings, and I guess investors aren't really happy with what they saw. What do you think about AMD moving forward?
Yeah, we should have did the show yesterday. That number would have been
it would have been different,
higher.
Exactly.
So again, I think the chip sector, it's a commodity now, and commodities are going to be cyclical. And some of these companies, they're reporting excellent earnings, and if the go forward projections aren't quite where analysts or otherwise want to see them, then the stocks are unfortunately getting hit. So I think, with AMD, it was, again, a play where, it had significantly lagged its peers like NVIDIA and TSMC and others. And generally, these types of companies, they'll all eventually catch up to each other somewhere along the lines. And so AMD, while the tech play almost looked more like a value play where it just looked mispriced. And so we took advantage of that, and, we're able to generate really good returns. And same thing, I probably wouldn't sell today, I guess, but throughout the last couple months, we've been piecing out of the position, but still, hold a little bit across the book.
Okay, let's take another quick break then. We'll get to more phone calls in a moment with Cole Kachur of Wellington-Altus Private Wealth. He's taking your questions on North American stocks as well as ETFs. Back in a moment. Welcome back to Market Call. Let's go to Elliot. He's on the line in Hamilton, Ontario, with a question today for Cole. Hi, Elliot.
Good afternoon. Despite artificial intelligence exponentially increasing the number of cyber attacks on our institutions and companies, Palo Alto has dropped from 220 to 165. Is this simple multiple contraction, or is it correct perhaps that Palo Alto and CrowdStrike have been lumped into the wrong ETFs, the ones that cover SaaS companies like Salesforce and Adobe? So by extension, it's being slaughtered when it really doesn't belong in those ETFs to begin with. Please, your thoughts on Palo Alto, and what is the current multiple? Thank you.
Okay, so Palo Alto, do you want to talk about it under the banner of ETF, or you want to talk about it as a standalone?
Well, I'll maybe touch on both, actually, because it's an interesting point. So, as a standalone, I think Elliot wasn't wrong. It's not like cybersecurity companies should be going away. I don't know that they're easily replaced. I think, they have to continue to change with the future. So, it could be something as simple as multiple compression where, just because a stock was something, it doesn't necessarily mean that was the value of it. We've seen that with silver or something that has went up substantially and then drops 30%. So I think, Palo Alto as a company is a good company, and, maybe the price should have never been, 220 and, 160, or is more reflective of where it could be. But going forward, I think, whether it's Palo Alto or I've liked Cloudflare, which is a little bit different, sector, but similar type of company. So I think those types of companies will be good. They are volatile, though. Interesting point about, companies getting caught up in ETFs. I haven't looked at it, but I would say there's a high probability that, Palo Alto would be in a software kind of sector ETF. I don't know if that could do as much damage in regards to, just share sales and pushing it down. I've never, really thought about that, but I guess theoretically it could. I just think that, probably more than anything, people are stepping away from that sector a little bit. And, Palo Alto is maybe slightly in a different sector, but it's getting lumped in with some of the other names.
Got it. Okay, let's go to our next caller. Frida's on the line in Chilliwack, BC. Hi, Frida.
Hi there. I'm interested in your projections on Shopify as it's taken a deep dive, but getting upgrades from significant companies. What do you see as the value of Shopify right now? Is it just fear-based selling, or what do you think? Thank you.
Okay. What do you think is happening with Shopify, and what is leading to that sell-off?
Yeah, again, it seems to be the rotation out of some of the high flyers over, the past year or so, where, companies like Shopify, they appreciated it fairly significantly coming out of the April lows. And then for whatever reason, and sometimes there's no reason, you just get a sell-off. So it's, you see it with a company like NVIDIA or, a lot of the tech companies. Sometimes you just get caught in the laundry and you have to ride it out. And I think Shopify is probably, the best Canadian technology name. And, if you wanted to own tech specifically in Canada, then I think it's somewhere where you could continue to go. Their platform is used across significant, marketplaces, and I don't know that that's going to change. So again, it's just, you kind of use these opportunities where things go down to high grade portfolios. And if you think Shopify is the best out there, then great. But, I might want to look at a Microsoft or a NVIDIA that's maybe sold off and say, in the long term, this probably maybe has greater upside than Shopify.
Okay, that was for Frida. Let's move on to Mike in Delta, BC. Hi, Mike.
Hi, Marella. Thanks very much for taking my call. Cole, I'm an income investor, and I'm looking to increase my position in fixed income. And I'm just wondering what you might think of the ETF CDX as a defensive play in high-yield bonds. Thank you for taking my call.
Okay, we don't have the graphic, but can you speak to CDX?
Yeah, so, with high-yield bond, the bond market's been tough, frankly. It's, some of the things that have traditionally supposed to driven the bond market higher, they haven't really worked as well, as what they're supposed to have. So it seems like there's a little bit of a disconnect right now between, the traditional usage of bonds to diversify a portfolio and, the income generation that comes from them. So, I think the high yield fund that he's talking about, it's good. No qualms with owning that or having a position in it. I think the bigger thing is, theoretically, when interest rates are being cut as aggressively as they have in Canada and, a little bit in the US, I would have expected some of the bond funds to perform better than what they have, and for whatever reason, they just haven't. So it's a little bit confounding where sometimes things don't do what they're supposed to. So then I would kind of take a look at, maybe alternative income sources and figure out if there's a better play out there than just a traditional bond fund.
Okay, let's move on to our next caller. Sarah's in Thornhill, Ontario, with a question. Hi, Sarah.
Good afternoon. Thanks very much for taking my call. Really appreciate it. Great program. My question is on ETF XLS, please. If I may get your opinion, Cole, really appreciate it. Thank you. Have a good day.
Thanks for the question. State Street Financial Select Sector ETF is what I have. Do you know this one?
Yeah, that's the financial sector one, right?
Yes, Financial Select Sector.
Yeah. So, it's been a good kind of medium-term holding. I think it's. I'd have to refamiliarize myself with it as relation to Canada versus U.S. exposure, but generally, I think the financials in Canada are, fairly, if not overpriced. So I would think that, with the Canadian exposure to it, there's probably a little bit less upside. I just don't see, a lot of drivers for what's going to move, things like Canadian banks and even the insurance companies that are priced fairly high right now. Probably a little bit more value on the U.S. side of things, but if I remember correctly, this is more Canadian domiciled and focused. So it's okay from an income perspective. You generate a little bit of yield. I don't think the returns on it will be anywhere near as high as probably what they were last year.
Okay. Let's take another quick break before we get to our last block with Cole Kachur. He's with Wellington-Altus Private Wealth. We're back in a moment. Welcome back. We want to go to John on the line in Ottawa. He's got a question today for Cole Kachur. Hi, John.
Hi there. How you doing?
Good.
Good. I'm calling about Main Street Equity. I want to make sure I'm invested in some value stocks, and I hear people talk about how well valued it is, and it's been sitting pretty flat in a way for almost 2 years. So I've been adding to it, and I'm just curious if you think that's a wise investment to continually add to at this point.
Okay. Thank you for the question. Real estate theme here. What do you think about Main Street Equity?
Yeah, so it's a little bit unique in the REIT sector in that it, as far as I remember and can tell, it doesn't pay a significant dividend, which, to me, that's a little bit frustrating. If, I'm a long-term holder and I'm not really getting capital appreciation, then at minimum, I want to get the cash flow and dividend yield from it, which, the bulk of REITs do pay out. So, it's looking at it from a chart perspective, over the last year, it doesn't really seem like there's a whole lot of excitement going on. It's kind of making lower highs and lower lows, which, from a technical perspective, that isn't really, what you want to see. So then, is there a catalyst that's going to turn it around? I'm not familiar enough with the company, to be honest, to say I would know of the catalyst. I wouldn't really see one, but, for me, I'd probably, again, look at capital elsewhere. And if you're going to invest in something over a long period of time, at least try to get some yield out of it.
Okay. That was for John. Let's go to another John in London, Ontario. Hi, John.
Hello, Cole. My question is on Honeywell. I have a small position. Honeywell is going the way of GE. It's spinning off its divisions. First was Solstice, the Applied Advanced Materials Division. That was in October. Then Aerospace, which is supposed to be in the summer, and then Automation in the fall. Do you think Honeywell is going to unlock some more value the way GE did? And if so, should I add to my position? Thank you.
Thanks for the question. Go ahead, Cole.
Yeah, it's got the template to follow. I mean, GE was very successful in it and drove a lot of shareholder value. I guess execution matters, right? Just because the template's there, it doesn't mean that it can necessarily be replicated. I think Honeywell, it's in an interesting sector right now. Obviously, there's a lot of interest around defense and spending in those types of sectors. So I do think it's a good company. It seems like it hadn't done very much for a while, and finally it's starting to kind of reward shareholders. So I think it's as a a diversifier, maybe out of the S&P and out of the mega cap tech and that, which kind of drives some of the markets. I think it's a good company to own.
Okay, let's go to our next caller, Frank, on the line. He's in Toronto. Go ahead, Frank.
Oh, hi. Thank you for taking my call. I'm just on the world's second largest gold miner, Barrick Gold. Is it a good buy today, and they have earnings tomorrow? Just wonder, what is your prediction for tomorrow? Thank you very much.
Okay, let's get to your prediction, Cole.
Yeah, I mean, based on the price of gold over the last quarter, earnings should be good. I would anticipate that they're mining and pulling as much as they can out right now as prices are high. But on the other side of it, it's also fairly reflective in the stock price already, where it's I think up 120 or 130% in the last year. So it's not like good earnings aren't already priced in. So I think with mining companies, we touched on Hudbay earlier. If the prices stay, then these companies should be able to continue to drive earnings, but they're probably going to run into similar things as like an AMD or an NVIDIA, where not only do you need good earnings, you need like perfect earnings, because that's the expectation now. And I see the stocks kind of trading off a little bit today, and it might just be that the stock is already priced to perfection, and the market's just taking a little bit of time to see what tomorrow looks like.
Okay, that was for Frank. Let's see if we can get you this last email from Eddie. What is your outlook on, I think it's CPKC, was his question was? They can correct me if that's incorrect, but I think it's on the rails.
Yeah, for sure. I guess like pretty neutral on the rails. Like, I don't know, CP and CN, they're fairly similar. They're kind of like an economic bellwether, and a lot of people are thinking the economy is going to be slowing down a little bit, and okay, so then what does that do to the pricing power of some of these companies? So I think they're like great long-term legacy companies, both CP and CNR, but in terms of like the best place to get return on capital, I think CP, I think both of them you could make money, but I don't know that it's going to be over the moon type of money.
Okay, let's take another quick break then. We will have new top picks from Cole when we come back. Stay tuned. Join us tomorrow on Market Call. Kim Bolton will be with us on the show. He's president and portfolio manager at Black Swan Dexteritas. He'll take your questions tomorrow on technology stocks. And if you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to top picks from Cole right now. Amazon is where we start, AMZN on the NASDAQ. Why do you like Amazon in the big tech space, specifically, Cole?
Yeah, so like a lot of the other names, it just kind of moved sideways here for what seems like the last 6 or 8 months. And just over the last couple of weeks, it actually had a pretty clean breakout of the sideways pattern. And now with the recent market weakness, it's kind of having a retest, which is something that generally, if you get the retest and bounce, then, that can pave the way for, the stock really performing exceptionally well. So it's part from a valuation standpoint, part from a technical. But I think that Amazon, it's just a company that continues to be ingrained in day-to-day lives, and they're going to be part of this AI build-out, and it probably improves their operations and profitability, and I think it can be a major benefactor of some of the technology. So. I think it's, and one of my next picks is going to kind of hit that sector as a whole, but I would probably pick Amazon as a top pick for, the mega caps.
Okay, let's get to your next pick, which is Chipotle, which did report earnings just yesterday, CMG, on the New York Stock Exchange. And they've been hit. It's hard for them to sort of gear up in a climate where consumers, especially in the U.S., are watching closely their wallets and don't want to spend as much or don't want to eat out as much. And the obesity drugs are factoring in here, which I always find amazing. Why do you like Chipotle where it is today?
Yeah, so to me, it's more of a value play. I think, different than maybe Cava and some of these other bowl brands that, are down substantially. I think Chipotle has proven over a long track record that, they can make the adjustments and that they're a well-run company and there's a lot of brand loyalty there. So I understand that, it's maybe not the perfect environment for a company like Chipotle, but I believe that that's also being reflective in the stock price where I think it's, down 25 or 30%. So, and part of me also sees like their earnings yesterday weren't amazing. They reported some same store sales declines, et cetera, and the stock didn't really get punished. And so to me, that's a positive sign where the turnaround story is being believed. And again, this is going to be a little bit of a grind, but I think that there's going to be some upside if they can execute on the turnaround.
Do you worry at all about their expansion plans or opening up a lot of new locations, and they still are moving forward with that despite the climate?
Yeah, obviously, it's a capital expense and, you need to get ROI. So without a doubt, I guess that's where you hope that the management team, is well placed in their views of what the brand and the stores and the new locations can be. And so to this point, they've proven that they can do it. So I guess I'm going to double down on that belief and hope that they execute and, it starts to push sales growth higher.
Okay, let's get to your third pick, which is also a tech pick you mentioned, but more broad. Evolve Fangma Index ETF, hedged. So tell me about this one, why you like it. There are so many of these tech ETFs now. Why do you like Evolve?
Yeah, so basically this just splits up into 6 names. It's Apple, Amazon, Google, Netflix, Microsoft, and maybe missing one, but anyway, you get the gist of it. And so it's just very select, where I think the bulk of those companies probably have 20% upside or more. So maybe the only one in there that, I'm not in love with just because it's moved up so much is Google. But as a whole, I think all of the names in there, again, have moved sideways. They're kind of in the middle of a little bit of a sell-off and a rotation. And I just think in general, if the market's going to go higher, typically it's got to be, the biggest weightings within that market that's going to drive it there. And so a lot of those big companies, I think, there's value to be had there. And sometimes you don't need to recreate the wheel. You can just own what's proven to be the best, and hopefully they continue to, perform in a manner that they have in the past.
And sorry, you said Google is in their Alphabet, and you weren't overly optimistic about that one because it's already been gaining so much?
Yeah, it's just had such a substantial gain. And again, it's almost like the Canadian banks, some of these tech companies, like you'll have a leader and then, they'll dip down a little bit and something else will become the leader. So, I'd probably have a preference if like Google was replaced by NVIDIA or something in there, just because I think there's a little bit more upside. But, you can also go and buy some individual stocks and, kind of round it out.
Got it. All right, Cole Kachur, got to leave it there. So thanks very much for joining us.
Have a great day. Thank you.
And thank you for joining us today in Market Call. We'll see you back here tomorrow.